There's growing consensus that the world is slowly starting to emerge from global recession. But the view is not universal among the economic experts. Michael Hudson is Professor of Economics at the University of Missouri. Michael Hudson, thanks for your time.
Well, thank you very much for having me.
Why is it, do you think, that you're less optimistic about the immediate course ahead for the world economy than many of your economist peers?
Because I'm looking at debt and looking at debt deflation. And as interest rates are going up, especially in Australia, people are having to spend more and more of their income to pay off the debts they ran into during the bubble. And this leaves less money to be spent on goods and services. And this means that retail stores are finding fewer sales. It means that malls, certainly in the United States, are closing down. It means that the break in commercial real estate in the United States is now looking more serious than the break in residential real estate prices. Foreclosures in the United States are only recovering about 53% of the value that the banks have lent out, and the banks are only foreclosing on the very best, highest value properties they can, and they're all worried that the debt deflation is going to continue and shrink the economy more and more.
So what does that then mean for the world's largest economy, for the United States?
It means that the U.S. is not going to be the market for foreign exports that it was before. So foreign countries that have built up manufacturing capacity to sell to the United States are now going to have to look to their internal market more and more instead of giving them away to the United States.
Does that mean that the decoupling that was talked about before the gravest implications of the global financial crisis struck are now starting to emerge as Asia, at least, appears to have escaped the worst of the global financial downturn?
The quantum leap in the decoupling began last summer at the meeting in Yekaterinburg, Russia, for the BRIC nations, Brazil, Russia, India, and China. And they announced that they want to have an alternative to the US dollar and an alternative currency block. And so China has begun to issue current bonds in its own currency. Now, it's not issuing these bonds because it needs foreign currency, and it certainly doesn't want to raise the exchange rate, but it wants to get the market familiar with seasoned Chinese bonds that have a market value, and as that happens, they want to do what the United States have done. They want to issue more and more bonds running a deficit that will pump the bonds into the world market so that they can get the kind of free ride that every country that's issuing a currency is able to get.
So does that mean the Chinese are looking to a post-US dollar dominated world, and is that a realistic option?
It's a realistic option because very few countries in the world want more dollars right now. They're all treating it like a hot potato, just as U.S. money managers themselves are. So everybody realizes that the dollar has shifted its focus so far away from industry, so far away from capital investment towards just inflating asset prices that it turns out that the economy doesn't get rich just by raising housing prices or raising stock prices. And there's very little investment there, and other countries realize that the whole neoliberal attempt at making money off money really doesn't work, that you really only make money off production.
Off widgets.
That's right, exactly.
So finally, does what the developments that we're seeing currently, with Asia having weathered the storm, the outlook for the United States may be pretty grim, but can the world economy start to forge ahead without the United States recovering to a substantial degree, or will it be a millstone around the neck of the rest of the world for the foreseeable future?
The world is doing everything it can so that it will be able to proceed without the U.S. as a big market. And the way to do it is to focus on the internal market, largely by changing the tax system around and away from what it is now, to prevent another real estate bubble. Basically, they're going to increase the real estate and property tax, remove the tax off labor so that they'll bring down housing prices. They'll also bring down the supply price of labor and capital and become much more competitive. So they're actually going to do the reverse of the tax policies that have been followed since 1980 through England, America, and most of the rest of the world. And it's that reversal that's going to help them recover.
Michael Hudson, thank you very much.
Well, thank you very much for having me.